Marina Hritsyshyna, and I want to welcome you to the next episode of the podcast Clean Energy Talks. Today we will talk about project finance for energy projects with Shubhda Kaushik. Shubhda is the founder and CEO of Alternative Energy Company. She brings over 14 years experience in global field with intersection of capital strategy and the energy transition, with background in project finance, consulting, and project management. Shuka, thank you for your participation today in this podcast.
Thank you so much, Marina. I'm glad to be here.
I'm also very glad to speak with you about this topic that's very important for development of energy projects. You have worked in the project finance, strategy consulting, and project development. How did your journey begin, and what attracted you to the energy sector?
So I think my journey began right when I was in the engineering college. I did civil engineering, and I got hired by Reliance, which everyone knows is an energy company. I spent 4 years there, a couple of years in contracts and commercial team and 2 years in corporate finance team. So I got introduced to both energy and business side of the things right after engineering. And I thought that it makes sense to go for MBA in finance and strategy, given the background. So I did that and got hired by Standard Chartered Bank. Core expertise was project financing. Because I had that background in Reliance, I thought project finance would suit me the most compared to leveraged finance or M&A. So I think it was both a combination of what I got as my engineering major, which was civil engineering, what opportunities came to me, but at the same time, I found it super interesting to deep dive on a project and really understand what the cash flows would look like based on the contract structures and based on the real projections instead of just hypothesizing a 5% revenue growth or a.
It's very inspiring way through the technical expertise to the financial topics, it seems to me. And at the same time, I think your technical experience background is very useful because in order to understand how to support financially energy projects, it's difficult without technical background. I know that you started your company, Alternative Energy Company. What inspired you to establish this company, and what gap in the market were you aiming to address when you founded it?
Launched Alternative Energy Company almost a month ago. I think it was a combination of three different things. One was hope, because I think that energy transition does have potential to speed up and reach the targets. Second was also frustration, given that I have seen in the last 14 years similar story being played out. Very ambitious projects, people with great vision, but there is a gap, which is bankability gap, a hurdle that most projects just face and simply cannot cross it, because the learn in project financing is you have to have the fundamentals strong from day one. And sometimes I felt that project financing or bankability or investability of a project was an afterthought, and people get very excited about technology, about the innovation, about what demand it can meet and how it is actually decarbonizing the emissions, etc. What's lacking is that strategic, financial, and systems thinking from day zero. Companies do not have that expertise in-house, because most of these companies are technology companies and they focus on a very different thing when they begin, and they get VC investments for the vision and for the technology that they have in mind. But when they reach that late stage, they need a different sort of financial acumen and strategic thinking. And at that point of time, your typical commercial banks or financial institutions are not there to take on that sort of risk. They are structuring, and the answers that these investors look for are probably missing in the investment story that the technology companies take to these investors. So there is definitely a communication gap, and I felt like there is a need for a boutique, lean advisory team that can serve these companies, probably like similar to an in-house team that they like to have certain risk structuring, mitigation strategy, planning, and financial modeling that they can easily comprehend and is written in their language. So I feel that that white space, that gap, can be something that AEC can fulfill. And I also feel like this requires a lot of stakeholder alignment with technology consultants, regulatory experts like yourself, and bringing everyone in the same room on the same page and getting it done. So I think AEC can serve as that platform.
So if I correctly understand, you propose turnkey solution for support of the technical companies with attracting financial support with banks and others. So especially take into account the questions about bankability and other issues. I think it's really important to have such possibilities for investors, especially in new technologies. However, our main topic is project finance, and for those who are less familiar with project finance, how would you explain what makes it distinct from the other financing options, especially in the energy sector?
Well, I'm a big fan of project finance. Even after I left banking and joined McKinsey, I would try to not let go of those fundamentals and continue to force fit some of those frameworks in my strategy studies. One or two things that I would like to point out about project finance is that it's very niche, very sophisticated, and very unforgiving. You do not have any recourse to the sponsor's balance sheet. The project must stand on its own two legs. So essentially, a project finance transaction will only happen if the cash flows for the next 15 years, 20 years can serve the lenders, can also have enough cash flows in the debt service account. There are certain covenants that have to be met, not relying on your sponsors or your company's balance sheet, but only on the project's assets and project's revenues. Long term, capital intensive projects and assets. So you are taking on a huge debt, not giving them any other guarantee apart from the assets, cash flows, and it requires a very rigorous due diligence, and the banks have to be super comfortable with the structuring, with the cash flows. It gives you then a cheaper financing than what you would get from a balance sheet financing. So you get the debt purely on the basis of your project, and of course your credibility as a sponsor to be able to deliver on that project.
If I correctly understand, this approach is based on the bankability of the project, because the bankability means cash flow. What are the core requirements for making an energy project bankable?
You have multiple risks that you assess, and a typical project finance framework would have, number one, offtake risk or revenue visibility. Is there an offtake contract in place for the next 10 years? Are they credible buyers? Would they proven are they? Can the technology actually work for the next 10 years? So that's another risk due diligence that you do. But before we even go to the offtake, there is construction risk. Do you have the right EPC players to deliver on the construction timelines? Because a lot of these projects suffer with cost overruns and construction delays, and that also increases your capital expenditure because the interest during construction period, which we call IDC, also starts to compound. during your construction delay. So it's not just your capital cost, the fixed cost, the hard costs that's increasing, but also the soft costs, the interest costs that continue to rise. So it is super important that the construction risk is as mitigated as possible. Then, of course, you have um, de-risking mechanisms. For example, having an ECA on board, party, an entity, which is Export Credit Agency. If you are importing technology from a country which has an ECA, then they can actually give you a sort of a percentage of your debt can be insured by them. And that's a ECA tranche is also at a cheaper financing rate, and that's a bit more complicated, and I can get into that in probably our next episode. So apart from technology, construction, sponsor, offtake, then OPEX risk, how do you think your operational expenses will increase if you are only taking a debt for 10 years with a bullet payment at the end of 10 years? Then what's your refinancing risk? Like, how are you planning to repay that bullet payment in the end? So these are some typical risks that we see, but obviously it changes a lot with the kind of project you're working with. For example, there are a lot of transportation and logistics and storage risk involved. That's also a key factor to look into. Also, there is currency risk. So, how do you hedge your forex risk? For example, all the investments, all the capital expenditure is in, say, euros, but all your buyers are, say, in US, and the payment terms are in USD. Multiple things come into picture based on the type specific project. But the key risks that we see in these energy transition projects is off-take risk, technology risk, and regulatory risk, which is super important. Like, if you are relying on certain policies, how credible, how durable those regulatory policies are going to be. Is the government support really rigid, or is that something very hypothetical at the moment?
Quite a difficult, complex topic, bankability. So, from my understanding, thank you for your explanation. So, it's important to have off-take agreements. Also, we have in Germany, for instance, export credit agency agreements for support of different projects outside Germany. I think H2 Global initiatives or Hydrogen Bank is also a very good option. However, it's still quite challenging. And I believe that maybe for energy projects, still it's a lot of other risks that it's important to take into account. And based on your experience, what are the most common reasons energy projects fail to reach financial goals?
Well, I would not be able to pinpoint one common reason, but I think that a lot of all the risks that I just spoke about, there are so many interdependencies as well. The regulatory policies drive your offtake, essentially your demand. So if regulatory policies do not come through, for example, what we are seeing in MEPC 83 IMO recent setback, if someone was actually excited about an ammonia project or a methanol project for shipping, and was considering Maersk or some shipping companies as their potential off-takers, they would now be facing a setback because the regulations are not in place, and hence the off-take demand will not be in place, and hence the revenue visibility is not there. And simply, one thing falls off, everything goes off at the same time. Everything is so interdependent. And second, it has to be delivered in those timelines. If you promised, as per your offtake contract, if your COD is 2030 and you were supposed to actually start generating revenue in 2031, and that's when your debt service starts, if there is a delay there, you are already defaulting on your obligation. So banks are very worried about those things because they do not have any recourse to the sponsors. Any delays due to, say, the technology equipment, which was supposed to arrive by a certain timeline, and it didn't because of the supply chain issues. I mean, you know about the whole Russia-Ukraine war. It disrupted a lot of supply chain logistics. A lot of turbines could not be delivered on time for the offshore wind projects, and a lot of those projects actually failed to meet their milestones, their construction milestones, which are very clearly stated in the financing agreements that XYZ percentage should be completed by year one. If you default even on one or two of these milestones, the basically the financing goes off. So and what it needs is therefore very, very rigorous planning and due diligence before you even go to an investor or a banker to ask for the debt. You have to have a mitigation strategy in place that, for example, the technology company does not deliver you your equipment on time, then what recourse as a project do they have? They also need to then pay you some money, to for default, or can they be equity partnerships so that they have skin in the game to deliver on time? For example, an off taker or a feedstock supplier to also have some skin in the game in form of equity, or to have very stringent performance guarantees so that they are incentivized or penalized to deliver on their obligations. Hence, like I said, a lot of due diligence, contractual strategy, and rigorous planning plus risk mitigation has to be in place. And if that is not there, projects generally fail.
I understand it's a lot of aspects, special regulation. I agree that's right point, especially taking into account the US approach to the development of hydrogen sector, for instance. Yes, we need to have predictability, especially for investors, for long-term perspective. And I agree that maybe the main problems on the current stage of development of energy projects. However, you mentioned that we can consider different types of projects for different hydrogen careers. How this project finance differs from hydrogen, EFuels, or ammonia compared to traditional renewables like wind or solar?
When wind and solar started, they were at a similar point as these projects are today. Perhaps they had more, there was a more localization of the demand. It has a PPA with the local government, a local entity. So a lot of risks that come with hydrogen, ammonia. They have a project in one place, the buyer is in a different country. So I think the stakeholder alignment is a bit more complex, of political complexities as well. Policy alignment and the stakeholder management is more complex compared to the renewables. But that said, when solar and wind started, it all starts like that. Everyone doubts things in the beginning, but you just need to have a few more proof points. Planning definitely increases a little bit of predictability.
Yeah, I agree with you. I had the similar experience 15 years ago in Ukraine with renewable projects, wind energy especially. I had the same approach that it was the first project without any clarity about the demand, especially it was very expensive. But now we can see that renewable electricity is quite popular and projects are quite how to say it, into development have less problems in comparison with hydrogen. So maybe it's a question of time. And of course, yes, with hydrogen derivatives, we have questions about chemicals, about infrastructure, with ammonia about some other topics connected with security for transportation, especially.
Exactly. I mean, sorry, just the point here, like for renewables, for solar, wind, these were the end product is pretty simple, power. End product is not necessarily just that. It can also be bought. For example, you're producing methanol, then methanol can then be bought by someone to produce methanol to jet. So not just one off taker in picture, right? Like who's the end consumer? How is that industry going to evolve? How is the intermediate industry going to evolve? So a lot, and I think the technologies are also a bit more complex compared to solar or a wind project. So these two things are also I just wanted to highlight apart from the policy and complex stakeholder alignment, given it's more global than local.
Yes, I agree. But some people say that it's not a completely new technology, especially for ammonia, for instance, or some other production of hydrogen. But still, we can see that the industry starts from some pilot project. And
Mm-hmm.
your experience, when do we expect the large scale of the projects in hydrogen sector, for instance, or in some other new technologies?
There is already a lot of projects that are very large scale and in the pipeline. But I mean, NEOM achieved FID, but it is going through its own challenges. That was a very marquee project. I think it was oversubscribed when they did the project financing. So the ambition is there, but given the policy uncertainty right now, it's hard to predict when will they achieve FID. Um,
Yes, it's true. However, if we consider the future, as we move forward to the 2030 and 2050 net zero goals, how do you see the project finance development?
Even project finance bankers need to evolve. It is a very traditional, very uptight, rigid set of bankers, very risk averse. But I think after a point they cannot just rely on doing renewables deals. So they need to also get off their high horse and somehow work together with these project developers to come up with innovative structures and not a very traditional project finance playbook that every risk has to be mitigated to the T. How can you de-risk a project further? Can there be a mezzanine tranche with certain debt and equity portion? Can there be certain development banks or ECAs to de-risk such projects? And also just as a guiding counselor, giving direct as bankers, as project finance bankers, direct inputs on what clause in the PPA can actually help make this project less risky for syndicating with other banks as well, for underwriting it with other banks as well. So if project finance bankers are waiting for developers to bring a perfect project with a perfect offtake contract, I think that's a very collaborative approach. If they can actually work together and give counsel, of course, give their direct inputs to the government, to the off-taking entity on how to what is it that they would be comfortable with.
Thank you for your insights about project finance. I think this topic is very important for development of energy sector, not only in the EU but in other countries also, according to the decarbonization targets. And I want to ask you the last question about advice. What advice would you give to other professionals who want to build a career in the finance and to support also projects with financial topics?
Well, as a young professional, when I was just starting out, I think three things that were told to me was one, if you want to build a career in project finance or say strategy consulting, number one, always stay curious and therefore read as much as you can. These are very in-depth topics. The more you know, the less you know, sort of a thing that you would feel that, oh, I can continue to read more about it. So be read as much as you can about the industry that you're focusing on. As an associate or an analyst, I was just told put your head down and just get on with the model. So build very strong financial modeling skills. You're one single source of truth, which gives a lot of answers to your information memorandum. So be very strong in your financial modeling skills, read a lot, and third, just observe and learn from your MDs and seniors and directors who are around you. Got there with a lot of hard work and learned probably a lot during those years. So just observe and learn. I think that would be third advice.
Thank you for this advice and for your participation in this podcast.
Thank you so much, Marina. And by the way, thank you so much for being a part of AEC. I'm so glad you are also a part of the firm. So I'm super excited about how it's shaping up.
I'm also very excited to join your team. Thank you.